This is part 3 of our Chapter 5 video lecture where we discuss the tax deduction claimed on Schedule A. Most of the taxes that you can deduct are paid to state governments or local meaning county or city governments. And there's different types of taxes you pay to the state or local governments. The larger one is probably the income taxes that you pay. The most common way of paying state income taxes is to have it withheld from your paycheck. And when you get your W-2 form after the year is over, here would be the state information, including the amount of state taxes that were withheld during the year. So whatever you see here in box 17 can be claimed as a deduction here in line 5A. Also, if you had paid state income taxes with your previous year tax return, here we're looking at the year 2019, but if you filed your 2018 state return and you made a payment, a balance due payment, it probably was paid in the year 2019. So that balance due payment can be included here in this line 5A. Also, if you pay what we call estimated quarterly payments, quarterly estimated tax payments paid to the state government, you can also include it here. There are some states that do not have income taxes. For example, Florida, Texas, Alaska, Nevada. Those states would like to deduct something, so here's an option where taxpayers can deduct the sales tax instead of their income tax. Of course, you would deduct the larger of the two. So if you're deducting sales taxes, you need to check off this box here and then estimate the amount of sales taxes you paid during the year. For most taxpayers, they don't keep track of what they paid in sales taxes for the year. So the IRS allows an estimate either using the tables inside of the instructions for Schedule A or this online sales tax deduction calculator, where you would need to enter things like the amount of income. Here we're doing this for the year 2019. The income range. The income includes not just your income subject to income tax, but even income that's exempt from income tax. Probably your Social Security income, maybe pension income that's tax-free. And you would add all of that up and pick the range that you fall in here. And then based upon your family size, the larger the family size, probably the bigger the sales tax deduction. And in addition to this estimated amount, you can tack on any sales taxes for large purchases made during the year, like automobiles, or maybe you added an extension to your home. Whatever sales taxes paid on that big amount purchased during the year, you can tack it on to the amount that's now going to be estimated. Here we indicate the place we live. There's different rates where you live, right, for sales tax. So this is our campus zip code here in Honolulu. And then we were living in this area the whole year. And here's a summary. And here is the amount of sales tax, including now that additional we had paid on big purchases. So instead of the income tax you paid, you can claim this sales tax deduction. But for most taxpayers, if they do pay state income taxes, it will be larger than their sales tax deduction. Another type of state and local tax, state and local tax, sometimes they call this a SALT deduction, is for real estate. So if you own your home, if you own investment property that's not rented out, they're not business property, we'll learn about business deductions next semester. But this is for your home or investments that you don't rent out, like raw land. You would include that type of taxes here in line 5B. Now, if you have a mortgage, the financial institution may collect every month real estate taxes, but you cannot deduct the real estate tax you paid to the financial institution that they're holding for you. You only can deduct the real estate taxes when the financial institution, sometimes using what we call an escrow account, makes a payment to the government. And typically real estate taxes are due to the government twice a year. Okay, so you have to make sure you're following what the bank is paying and not what you're paying to the government for real estate taxes. Another type of tax is called personal property taxes. Personal property is taxes on stuff that's not real estate. And here in Hawaii, we do not have any personal property taxes. An example of personal property tax would be a tax on, let's say, your automobile. But here in Hawaii, don't you pay a registration fee every year for your automobile? Well, that's not a tax. That's not a personal property tax based upon the value. It may be just a fee also based upon the weight of the automobile. To be able to claim a personal property tax, the tax has to be based upon the value of that property. So here in Hawaii, we don't have anything here in line for 5C. Then you take a total, but the total state and local taxes is limited to a maximum of $10,000, which is very easy to reach for states that have high income and real estate taxes, like Hawaii, like New York, like California. So let's see, one more tax here, which it says others. The only other tax I've seen deducted here in line 6 would be any foreign income taxes. But we saw back in chapter 2, maybe a better place to report foreign taxes is a foreign tax credit and not a foreign tax deduction here in Schedule A. You cannot do both, yes? So the better place is to report the foreign tax back as a foreign tax credit that we covered back in chapter 2. Again, the maximum here probably is going to be based upon that dollar limit we see for line 5E, yeah, the 10,000. And if this is the only itemized deduction you have for the year, probably you're not going to itemize because remember, we take the larger of the itemized deductions or standard deduction. In the case of a single filing status for the year 2019, the standard deduction was $12,200, bigger than the $10,000 limit we have here. If you're doing a Hawaii tax return, you have to be careful because there's a different limit for income or sales tax based upon not a flat $10,000 limit, but based upon the taxpayer's adjusted gross income. Adjusted gross income. So in the case of a taxpayer that has a single filing status, if their AGI is over $100,000, they get to deduct zero taxes, zero income taxes. I think they still can deduct real estate taxes. It's just the income tax or sales tax that's limited if your AGI goes over that dollar amount. In the case of a married filing joint, if your AGI goes over 200,000, your income tax or sales tax deduction is zero. Okay, so different rule, different limitation for the Hawaii tax return. Okay, move on to the next video where we're going to take a look at the deduction for interest that was paid during the year.